Greetings from 3Edge Asset Management. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge. And I'm pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today is Saturday, April 18th, and this short video is part of a series that Steve and I are making at the conclusion of each week during this extraordinary period of market volatility. In addition to a brief market recap, we'll also tackle one topic in a bit more detail that has seemed to surface during the week. And as a reminder, all of our 3Edge Asset Management videos are available on our YouTube channel. So let's get started. As the US and the rest of the world continue to deal with the global pandemic caused by COVID-19, the US equity markets continued with their relief rally during last week. The S&P 500 rose by approximately 3%, while the NASDAQ composite rose by over 6%. Economic data released last week included another very large number of people filing for unemployment in the US, and unemployment claims have now risen to over 22 million in the course of just the past month, giving new meaning to the word unprecedented. The COVID-19 crisis continues, with thousands of individuals dying each day in the US. However, the IHME, in a press release yesterday, indicated that the number of daily COVID-19 deaths in the US may have peaked on April 15th, and they have revised down their estimate for cumulative deaths in the US. Now, by way of full disclosure, Steve is actually on the board of directors at the IMHE. And so, Steve, anything to add there about the most recent changes in the forecast from your group?
Well, it was very interesting. And I had a contact with Chris Murray, who runs the IHME. And what he said was that the biggest change in the variables that feed the model was the idea that people in our country are taking the social distancing even more seriously or more effective with it than was initially projected. So this is all good news.
Interesting. So this past week in Washington, D.C., and across the U.S., and in fact around the world, attention is now turning to the potential reopening of the economy and the easing of social distancing. And obviously the challenge will be to reopen the economy, allow people to get back to work, without suffering a resurgence of outbreaks of COVID-19 in the process. And so this brings us to our topic this week, which is the enormous disparity between investors who are more optimistic and those investors who are more pessimistic about the future of the global economy and the global capital markets. And just to put this in perspective, I'll give you a real-world example from the financial press this week. So, two experts, one fellow, Scott Minard, very well-regarded Chief Investment Officer of Guggenheim Investments, recently said that gains in the S&P 500 are unsustainable and the benchmark could fall as low as 1,200 when it retreats. And the benchmark closed, the S&P closed on Friday at 2874. Meanwhile, in the same week, Goldman Sachs strategist David Kostin said that thanks to the, quote, do whatever it takes approach of policymakers, U.S. stocks are unlikely to make fresh lows, and their year-end target for the S&P 500 index at Goldman remains at 3,000. So those are two very different opinions from two very well-regarded industry pros. And these two disparate views seem very much tied up in this conversation about the eventual reopening of the economy. So to help us frame this discussion, we're going to refer to a slide that was part of our quarterly webinar last week. And this slide is entitled, A Massive Economic Slowdown versus a Massive Government Intervention. So Steve, is this going to simply be a battle royal between these two opposing forces of massive economic slowdown versus massive government intervention? I'm thinking it's more nuanced than that. So why don't I turn things over to you and you can take us through the slide.
Well, Fritz, we do see it as a major tug of war between these two forces. We've had the steepest climb in unemployment in history. We've had the most massive money printing and rescue package from the government in history. And this is a tug of war, but it's playing out in sequence. So market first focused on the dire economic outlook and the severe recession that we now know we are all in, and this is worldwide. And then when the government came with their extraordinary, unprecedented stimulus, the market focused very much on that, as well as the hopes of getting over this coronavirus and getting back to normal. So we've had this big tug of war, but it's been in sequence, a historic down and a nearly historic up. In fact, the rally we've had over the last few days and weeks has been one of the sharpest rallies the market has ever had in history, going back to the 1930s. So how do we make sense of this? Well, think of the rescue package and all the stimulus as creating a bridge. And the bridge doesn't go forever. The bridge goes a bit into the future, counting on a rapid recovery of the economy. So the bridge is meant to keep everyone as much as possible solvent and stable, getting over to the other side, which is hoped to be in 10 weeks. And what that means is that the economy needs to get up and running soon. And the good news from the coronavirus projections are that it's possible to begin that process. But the economic recovery needs to be strong after that. And so the length of this recession is critical. No one's arguing how steep it will be. It will be, and it is already very steep, but the duration is very, very important. So if you think about what has played out in the last few weeks, in terms of an equity strategy, we were close to our minimum equity exposure in most of February and March during that big drawdown, and that helped us to protect our client capital. We were very defensive, not because we had a clairvoyant idea of how bad the coronavirus would be, but we knew that the market was overvalued, and we knew all it would take would be a trigger to get into a bear market. So after that, on April 2nd, we then raised our equity allocation to a more moderate level, still defensive in the grand scheme of things, but definitely well above where we were. And that has allowed to participate in some of this rally that we're having. The question is, what is causing this rally to continue, and how sustainable might it be? Well, the model recognized early in April that the Fed stimulus was very powerful. It went into our calculations to increase equities somewhat, but also our behavioral analysis showed that this was a natural psychology of a bear market, where you have, after an initial plunge, you have a phase two, or a relief rally, if you will, where there's hope for something good to happen. So those two things coincided and led to our increase in equity allocation. Now, this current rally is still being fueled by the idea that the Fed is committed to do whatever it takes, in their own words, to print money without limit. Also, there's this new enthusiasm that the economy is going to open up maybe sooner than was feared. There's new enthusiasm about developments in the pharma industry and new medications and new treatments. And then also, you get on top of that the momentum, or the trend following traders and the machines that do a lot of the trading day to day. And as the market goes up, it feeds more buying. So all of this has helped create this incredible rally that we've had just the last couple of weeks. Mm-hmm. Is it sustainable? Well, in every bear market, there's a reality check. You've got the initial plunge, you've got the relief rally, and then there's a reality check. And one must ask themselves, is the recovery going to be too slow? Mm-hmm. Will firms who got the initial bailout now run out of bailout money? And if the recovery is too slow, will they either go into default, or is it too difficult for them to refinance their debt? Has this rally come too far too fast? So it'll depend on factors like that to determine the duration of the downturn. And so for us, we think it would be dangerous to either follow the most optimistic view, put all our money back into equities and hope for the best. We also think it would be too dangerous to follow the most pessimistic view and maybe miss out, as we might have if we didn't reinvest on April 2nd, some of this recovery. So we think a moderate approach is appropriate now, but with our finger on the trigger to get ready to be defensive. A lot of people talk about a V-shaped recovery in both the economy and the stock market. We think that requires everything to run perfectly from here on. And as it shows on the slide, we could have a second wave of the pandemic. We could have caution from consumers so they don't go back to life as normal. And we could end up in the next downturn. So we're happy to be moderately invested. We've got our finger on the trigger. We won't hesitate to pull if our models and our research indicate risk is back. And I think that's how we'll play it.
Well, that's great. I think that really is very informative in terms of having to sort of thread that needle. And one thing that I think about in this environment is how the answer really to the question then between optimism and pessimism, it isn't necessarily binary. It isn't, one or the other. So I think that will do it for us. Steve, thank you very much for sharing your insights. Steve and I will be back next weekend with another edition of our 3Edge Weekend Update. All of our videos, again, are available on our YouTube channel at 3Edge Asset Management. Always feel free to reach out to us at any time with questions or concerns or just to discuss the markets. And lastly, on behalf of Steve and everyone at 3Edge Asset Management, we implore everyone to stay strong, stay safe, and keep the faith. Thanks for listening.